Good morning, everybody. Time to get going. So this week's guest is David Smith of Henderson High Income. Before we get there, though, we're going to run through a bit of news for the week. So some things that I picked out from a much busier week than last week. Hipgnosis Songs Fund, ThomasLloyd Energy Impact, and US Solar Fund. So Hipgnosis Songs first. I had to build this chart myself because the data in Morningstar is completely wrong. Apologies for that if you've been looking at it on our website. But one of the things that it did is it switched its accounting from sterling to dollars a few years ago. And so basically, this is all in sterling. And as the NAV's been rising, this is the operational NAV, and I'll explain what that means in a second. It's been falling more recently because of weakness in the dollar. And as we know, there's been quite a big widening of the discount. So the share price slipping, the discount getting wider there. And it is about sort of 50%, more or less, something like that. So it's just announced results for the year ended 31st of March 2023. The IFRS NAV, which is the sort of standing accounting practice NAV, was down 9.2%. So basically, though, the main driver of that was they have a book of catalogues that they bought, and because of the way the accounting standard works, they have to depreciate those over time, and that means the NAV falls. But they say the value of our catalogues is not depreciating in the real world, and so we've got an external valuer who values them. And we reckon that overall, the operational NAV, which revalues the catalogues at what they call fair value every year, was up 3.6%. There is lots of moving parts in this we'll come to. But they now reckon that operational NAV is $1.91. And the dividend, they've just maintained at 5.25p, but it was now covered by cash flow from operations after servicing the debt, which is obviously a good thing. It's one of the things that we'll be looking out for. So there are lots of different bits, as I said, to what's been driving this. Basically, all of this means that the income that they generated in the year actually came in a bit ahead of where they were actually forecasting in terms of where the NAV was. And that was one of the reasons why the NAV was up over the past year. One of the factors within that is the recovery in performance income, because obviously when COVID lockdowns were happening, bands weren't playing. Now that's coming back, that did flow through, but it didn't actually flow through until the second half of the financial year, because there's always a lag in the way it receives things. So they're saying there is more to come from this. Whether there's more to come from that or not, we all have to wait and see, but that obviously driven by things like the number of Spotify subscribers and what these streaming people charge their users to hear music. Now, in terms of the valuation, this is I slightly stretched this chart so to fit here, so it looks a bit weird. One of the sort of more controversial things that's happened is, although interest rates have been rising, the external valuer has not changed their discount rate, and a lot of people are saying this just means the NAV is completely wrong. It's one of the main reasons, I think, why the thing's trading at a big discount. This chart here is showing you, this is the yield on a 10-year US bond. Obviously, they've been going up. This is the discount rate that we're using to value the portfolio, which has been obviously flat for a long time. And so what this orange line here is the risk premium. So it's the gap between their benchmark rate, the risk-free rate, if you like, and then the discount that they're using. So obviously they're saying that these things get less risky. And I think that's debatable, but there we go. So it may be that NAV is a bit overstated. This is a sensitivity analysis that they put up in the back of the annual report. So this is just showing how sensitive the portfolio valuation is to movements in the various different bits and pieces here. This one here is the discount rate. So at the moment it's assuming at 8.5%, and on that basis, then the portfolio is valued at $2.8 billion. If that drops to 8, it's now 3.06. If it goes up to 9, that drops to 2.5 56. So there is quite a big swing there. You can see that. So a 0.5% move in the discount rate has a 9.4% or a 7.9% move in the NAV. And this obviously is important because obviously people are saying these things should have gone up, and maybe they should now, instead of 8.5, be 9.5. So that might imply let's just double that. So it's like sort of 15% fall in the NAV. But relative to a 54% discount, maybe that's doable, maybe that's acceptable. This is looking at how fast the income grows and whether it declines or not, and the sensitivity to this. So obviously there's something in there. And I don't think we need to bother about the last one. All of this stuff matters in terms of obviously what the NAV is, but one of the fears was that it might matter in terms of the loan covenants. So it's borrowed $600 million, and it was originally doing that at a floating rate debt, and they managed to fix it. But one of the things that we picked up last year was that the fix that they did was more or less about the same as the cash return that they're getting on the portfolio. So basically, they're not making any money on that part of the portfolio that is financed by this debt. And obviously, there was a worry that if the value of the portfolio fell, then we could see it breach a loan covenant, and then it would be a sort of fire sale of assets, and the whole thing would just go implode. What it turns out is, and this is something that I should have picked up before, is that, and I'm pretty sure this is, we tried to get the answer to this on the call yesterday, but they didn't really answer an awful lot of questions. The covenant that they're using, they are using the IFRS NAV, we think, to work out whether that covenant's okay or not. So they're saying that the current debt, $600 million, is 31.5% of the total value, and that works out more like 1.9 than 2.9. So basically, what I'm saying is, if the discount rate does move, because that's used for the fair value and not for the IFRS value, it's going to make any difference to this loan covenant. So that's good news. That's just a piece of something that's a little bit reassuring. And the other big thing that we think is important to focus on here is cash flows rather than anything else. Definitely don't worry about it. All you get with this stuff is just reams and reams of what's going on with the artists and where they're placed in which films they're in. But look at the numbers, I think, is the most important thing. So it did generate a bit more cash from operating activities, which is what you'd expect given what we've been talking about in terms of the increase in the portfolio income that we talked about before. They're no longer buying songs, which is obviously helpful, and that means actually these numbers are a bit more comparable than they were before. And it's easy to see what's happening year on year. They're using a chunk of that obviously to pay dividends, and there's a timing thing here, but it does look okay from here. And to pay interest, and after doing that, there's a surplus of cash. So actually the cash went up by 7 million. And that's clearly good news and slightly reassuring. But it's not very much to my mind. And this sort of still makes me a bit uneasy about it. And so all of this comes back to, is the NAV correct? What can they do about the discount? And the other thing you have to worry about is they've actually got a continuation vote this year, because they've been going for 5 years now. So at the AGM September, there will be a continuation vote. So what found its way into the statement was this comment from Merck, who's the manager, basically hinting that they are going to do something about this. Now, there's been a lot of talk in the press about what they can do. The most obvious thing is to sell some of the catalogues and use that money to buy back stock. One of the questions in my mind, though, is if they're not really making any real margin on the debt finance that they've got, why not sell enough of the catalogues to repay all of the debt and a bit more, So just basically shrink the whole fund down. I know that doesn't sit with the whole manager's ambitions of trying to be this sort of huge influence in the industry, but I think it would be the sort of sensible option. The nuclear thing would be to look for a buyer for the whole portfolio, and then maybe that would be doable. They have cautioned, though, that there's some kind of tax implication in terms of selling portfolios, selling catalogues rather, and this is something that we need to dig into a bit more. But I don't think that's the end of the world. My inclination is that if they don't do something material between now and September, then I'm going to vote against continuation, and I would encourage other people to do the same thing. I think we need to see something a bit decisive here to narrow that discount down. So we'll have to wait and see what that is. ThomasLloyd, though. Now, this chart's a bit weird because basically, again, it's a dollar sterling thing. Obviously, for a long time now, it's not been trading. It's been suspended. And so all of this is just the slide in the value of the fund because the dollar values are being diluted by stronger sterling. And obviously, it looks as though it's trading a premium. It looks as though the only fund in the renewable sector is trading a premium. But obviously, if it were trading, I think we expect it to be an enormous discount now. So there's a huge downside potential in this. On the 12th, they said, we're not able yet to give you any sort of date as to when we're going to publish the accounts, which is the reason that the shares are suspended. If you remember, there's a problem that arose with an Indian solar plant that they were going to build. And it turned out that was going to cost an awful lot more than they were estimating. There's all sorts of liabilities around that. There's lots of question marks about whether the manager was on top of what was going on. There's question marks about whether the board was on top of what was going on. Anyway, that's all up in the air. What they've also said on the 12th was that there could be a much bigger write-down than just the amount associated with Solar Arise. That's a bit worrying, clearly. And it's really, I think, the death knell for this fund. It just doesn't really make sense. Because if you mucked up quite so badly as they have, I can't see how it can continue. But what the manager's done is requisitioned the meeting to actually hold a continuation vote that they should have held at the AGM, but they didn't because they basically said, again, we did talk about this before, we're going to have the AGM, we're going to run through all of the pieces like re-elected directors and stuff, but we're going to adjourn it before we get to the point where we hold a continuation vote and approve whether we can buy back stock or not. So that's what they did. The manager feels quite strongly that they should have gone ahead and done that, and that they tried apparently the meeting to make the chairman have his continuation vote. Then it didn't happen, and they will now want to hold it now. So because they've got enough stock to force the issue, they can ensure that the meeting gets called and the vote gets held. The board's quite upset about this because it says that shareholders shouldn't be voting on this while they're not in possession of all the facts. And it also had a dig at the investment manager saying it still hasn't applied a proper explanation about what went wrong. And obviously that's something that we need to find out too. But there is some good news in all this, because obviously if the continuation rate vote doesn't pass, as is normal in investment management contracts, there's no compensation for the manager. So at the moment, if they try to fire the manager, there'd be quite a big penalty to pay to the manager in terms of loss of earnings. That wouldn't apply if they lost a continuation vote. And so the board is saying, if you're going to hold a vote, we're going to say to shareholders, you should vote against continuation. And then we'll have 4 months to come up with proposals of what we're going to do. The heavy implication is that the manager thinks that the vote would be passed and it can just carry on like normal. I think that's maybe a lot of wishful thinking in there. And I'd really say, if you are invested in this, I feel sorry for you, but I do suggest you do vote against continuation. I think we have to make sure that thing now dies, because that's the best way forward for this, because it terminates that management fee to everything that's overhanging it. So even if it turned out, without this continuation vote, if it turned out that the manager had really failed in what it was doing, and the board tried to fire them on that basis, there'd still be a case that the manager would come back through to have a big chunk of fees to compensate it. I think this is definitely the best way forward for shareholders. So that's that one. And then one more basket case. It's all basket cases this week. US Solar Fund. And I've said before, I don't really understand why investors seem to have this antipathy towards this fund that they do. I don't really understand why the board gave up on it when it did. But we have now got this situation where the discount's totally widening, and the board sort of pressed the button and said something has to change. And this is all against a backdrop where actually the market for renewables in the US is booming. Because of the Inflation Reduction Act that Biden brought in, there's just huge subsidies to put new renewables in the ground. And so they can build new projects now. And if you put them in the right state with US sourced material and that sort of thing, you can get sort of 50% tax write-offs up front. These things are now very attractive, I think. But there we go. They sold off their interest in a project called Mount Signal, and that brought in $52 million. They used some of that to pay off their revolving credit facility. The board is looking at the cash requirements of the fund, but what it's saying is we will think about using the balance to buy back stock, which is obviously going to be encouraging given that the discount is widening out too. They've concluded from the sale that it doesn't make sense to sell the company or its assets. Now, this is a slight worry to me, because if the implication is you can't sell it for the NAV, then the NAV is wrong, because the NAV should reflect the kind of big value of the portfolio. It's going to be interesting to see how the board gets around that conundrum. So maybe that discount is not as wide as I think. They're also saying we're not going to renew the investment management contract. So the first 5-year term expires up 24. We're looking for a replacement manager now, and we think we're going to appoint one. I'd love it to be Ecofin. I know they've got an accident of their own with this tornado that we've talked about before. That's not their portfolio value, but that wasn't their fault, clearly. We've got these two funds that are a bit unloved. I think it'd be better to have one big fund that's a bit unloved and then sort that out. It'd be a lot easier, but we'll have to wait and see who it is. So that's enough from me.